Today, we're doing a complete breakdown of ASC 830. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine a multinational company reporting profits in the billions, only to see them vanish due to currency fluctuations. ASC 830 tackles this by standardizing foreign currency translation, ensuring transparent financial reporting. After this section, you'll understand how this standard provides a consistent approach to handling currency exchange impacts on financial statements. Before ASC 830, companies faced chaos with inconsistent currency translation methods, leading to unreliable financial reports. This standard emerged to bring order by providing a consistent method for translating foreign currencies. It ensures that the effects of currency fluctuations are visible, allowing for clearer financial comparisons and more reliable business decisions. ASC 830 must be followed by any entity with foreign operations, effective since 1981. Its cornerstone is using current exchange rates for translating financial statements, ensuring accuracy. Separate disclosure of translation gains and losses enhances transparency. This requirement helps stakeholders understand the true financial position, irrespective of currency fluctuations. The foreign currency translation model in ASC 830 ensures financial statements reflect true economic substance by translating foreign operations into the reporting currency. Adjustments go to OCI, separating them from regular earnings. Understanding functional currency is crucial as it defines the economic environment. This structured approach is vital for analysts, simplifying comparisons and analysis across multinational entities. Understanding the scope of ASC 830 is essential because missing the exclusions can lead to costly errors. Candidates often forget that transactions in the functional currency are not covered by this standard. That's a classic interview trap. Let's explore what ASC 830 really includes to avoid these pitfalls. ASC 830 is all about managing the complexities of foreign currency and financial statements. It covers foreign currency transactions where you convert items denominated in another currency into your functional currency. Think about when a US company buys inventory in euros, those euros need to be converted. Translation for foreign operations and hedging are also in the mix, helping companies navigate currency volatility effectively. ASC 830 doesn't cover everything, and this is where many slip up. If a transaction is in the functional currency, there's no foreign currency to convert, it's excluded. This also applies to domestic transactions as there's no foreign exchange component. Intra-entity transactions settled within the same currency or historical remeasurements fall outside ASC 830. These exclusions are crucial for finance professionals to remember during audits or interviews. The concept of functional currency is central to ASC 830. It's the currency that reflects the primary economic environment in which an entity operates. Imagine a US company with a UK subsidiary. Even though the subsidiary is part of a US parent, its functional currency might be GBP, since that's where it generates most of its cash. This distinction impacts how transactions are recorded and translated, ensuring financial statements accurately represent economic realities. Understanding foreign currency is key to mastering ASC 830. It's any currency that isn't your functional currency. Picture a US-based company selling products in Europe, receiving payments in euros. Those euros are foreign currency. Transactions involving these currencies must be converted, considering exchange rates, to ensure financial statements are accurate. This conversion impacts reported revenues, costs, and ultimately profitability, making exchange rate understanding crucial. Real-world scenarios often test the boundaries of ASC 830. Consider a US company invoicing in USD, but receiving EUR. ASC 830 applies due to the foreign currency component. A foreign loan in the reporting currency falls outside its scope. If a company changes its functional currency mid-year, complex adjustments are needed. During hyperinflation, special translation rules apply. These edge cases often stump even seasoned professionals, so understanding them is critical. Think about a multinational company with diverse global operations. How does it accurately report its financials when dealing in multiple currencies? The foreign currency translation model is essential here, converting foreign transactions into the entity's functional currency for precise financial statements. Currency fluctuations can wreak havoc on financial statements if not handled correctly. Our focus will be on Meridian Corporation's $10 million SaaS contract, where $8 million is for software and $2 million for services. The model ensures these figures accurately reflect in USD, aligning with financial reporting standards. The first critical step is identifying the functional currency, which reflects the primary economic environment of the entity. For Meridian Corporation, involved in a $10 million SaaS deal, USD is the chosen currency. Confusing transaction currency with functional currency is a frequent mistake. ASC 830 mandates that the functional currency aligns with the economic environment, setting the stage for accurate translation. With USD as the functional currency for Meridian Corporation, translating foreign currency transactions becomes crucial. The $2 million in services billed in CAD needs conversion to USD using the transaction date's exchange rate. Candidates often err by using incorrect dates, but ASC 830 requires transaction date rates. This ensures the $2 million is accurately reflected in USD, forming a solid foundation for financial reporting. After translating transactions, exchange rate differences need adjustment. Meridian Corporation's translated $2 million in CAD services must be revalued using the reporting date's exchange rate. Ignoring these adjustments can lead to inaccuracies. ASC 830 states that using the most current rates ensures that financial statements reflect real-time currency impacts, crucial for transparent reporting. Adjustments from exchange rate differences must be recognized in other comprehensive income. Meridian Corporation's $2 million services adjustment due to rate changes goes to OCI, keeping net income unaffected. Mixing OCI with net income distorts financial clarity. Under ASC 830, channeling such adjustments to OCI ensures transparency and integrity in financial reporting, keeping the core figures reliable. The final step involves periodically reassessing the functional currency. If Meridian Corporation's economic environment shifts significantly, USD may no longer be appropriate. Often, companies overlook reassessment even when conditions change. ASC 830 emphasizes the need for this evaluation during major economic shifts, ensuring the functional currency remains aligned with the primary economic activities. This vigilance maintains financial statement relevance and accuracy. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 830 guides finance teams in translating foreign currency transactions accurately, ensuring your financial statements reflect true economic realities, not distorted numbers. Understanding measurement and disclosure requirements is crucial for accurate financial reporting. Understanding when to recognize foreign currency transactions is crucial. ASC 830 mandates using the spot rate on the transaction date for initial recognition. Let's say your company buys inventory worth 100,000 euros when the Euro-USD exchange rate is 1.10. Record this purchase as $110,000, affecting both your assets and liabilities. Consider materiality when deciding on aggregating smaller transactions. Subsequent measurement under ASC 830 involves reevaluating monetary items at each balance sheet date. If the Euro-USD rate shifts to 1.15, your 100,000 euro liability now equals $115,000, affecting profit and loss. Non-monetary items like fixed assets aren't remeasured. When an entity consistently uses forward rates, it can provide a clearer financial picture, especially for hedged items. ASC 830 affects how foreign currency items are presented in financial statements. For instance, remeasurement gains of $5,000 are included in other income on the income statement. Monetary assets and liabilities are reported using the closing rate, ensuring your balance sheet reflects current economic realities. Your notes must clarify the exchange rate policy applied, enhancing transparency for stakeholders. ASC 830 mandates critical disclosures that offer transparency and insight. Disclosing your exchange rate policy explains how you manage currency risk. Revealing the nature and amount of foreign currency transactions provides stakeholders with clarity. Disclosures about exchange differences in profit or loss help investors understand fluctuating financial performance. Also, detailing significant foreign currency exposure helps analysts assess risk and forecast future performance. Imagine a CFO managing a €200,000 receivable due in 6 months. Using a forward contract, they lock in a rate of 1.12, securing the receivables value at $224,000. This strategy stabilizes earnings despite future rate fluctuations. By disclosing this hedging strategy, the company enhances transparency and demonstrates robust financial risk management, offering stakeholders a clearer view of future cash flows and risk exposure. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. ASC 830 guides how Meridian handles foreign currency transactions. The journey begins with the initial lease agreement, setting the stage for how foreign currency impacts financial outcomes. The initial lease agreement in Singapore dollars is translated to USD and recognized on Meridian Corporation's balance sheet. ASC 830 requires converting foreign currency leases at the exchange rate on the lease commencement date. Hence, the right-of-use asset and lease liability are both valued at $1,200,000. This sets the financial foundation for future adjustments. When Meridian Corporation made its first lease payment, the lease liability decreased by $240,000, reflecting the translated SGD amount. ASC 830 mandates recognizing currency fluctuations affecting financial positions. As payments are made, the lease liability diminishes, and cash outflows are recorded at the exchange rate at the payment date, ensuring accurate currency impact assessment. Quarterly lease expense of $60,000 is recognized, reflecting the cost of using the leased asset over time. ASC 830 requires this systematic recognition to align expenses with asset usage. The credit to accumulated amortization signifies the reduction in the right-of-use asset value, impacting both the income statement and balance sheet. A $5,000 foreign currency gain is recognized due to favorable exchange rate movements. ASC 830 requires adjusting financial positions for currency fluctuations, impacting the lease liability. This adjustment ensures that Meridian Corporation's financial statements accurately capture the economic effect of currency variations, maintaining transparency and precision in reporting. At year-end, a $10,000 loss from currency translation is recorded, reflecting the impact of adverse exchange rate changes on the lease liability. ASC 830 mandates this adjustment for precise balance sheet representation. This entry underscores the volatility foreign transactions introduce, emphasizing the need for careful currency management and accurate financial statement portrayal. The final lease payment of $240,000 completes the lease liability settlement. Simultaneously, the right-of-use asset and its accumulated amortization are derecognized, closing the asset's accounting lifecycle. ASC 830's guidelines ensure that all currency-related entries reflect economic realities. Completing the lease cycle, Meridian Corporation's financial statements now reflect the full impact of foreign currency transactions. Every Big Four and investment bank interview on ASC 830 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. ASC 830 focuses on foreign currency matters, guiding how companies account for transactions and financial statements in currencies other than their functional currency. It ensures consistency and comparability across financial statements. The key is understanding functional currency choice, not confusing it with reporting currency. Always remember, ASC 830 aims to reflect economic realities in the presentation of foreign operations. Functional currency is the currency of the primary economic environment where the entity operates, while reporting currency is what financial results are presented in. Mistakes often come from mixing them up. ASC 830 requires identifying functional currency first. Remember, functional currency affects transaction recording, reporting currency affects how it's presented. Initially, foreign currency transactions are recorded at the exchange rate on the transaction date. Changes in rates lead to exchange gains or losses recognized in the income statement. The common error is ignoring these fluctuations' impact. Remember, remeasurement is key. ASC 830 demands reflecting current exchange rates for monetary items. Translation adjustments arise when translating financial statements from functional to reporting currency. Under ASC 830, they are reported in OCI, not the income statement. Misplacing them can misstate earnings. Key takeaway: translation adjustments reflect currency translation differences, impacting equity, not immediate profit or loss. Indian accounting standard allows for more discretion in determining functional currency, while ASC 830 has stricter guidelines. A common trap is thinking adjustments are treated similarly. They aren't. Remember, ASC is more prescriptive. Indian accounting standard allows for judgment, but increases risk of inconsistency. A $100,000 foreign sales transaction affected by a 1% exchange rate change results in a $1,000 gain or loss, impacting the income statement. Candidates often overlook minor fluctuations, which can aggregate into significant effects. Memorize this. Every 1% change equals $1,000 profit or loss in this scenario. Goodwill is not directly translated under ASC 830. It's tested for impairment at the reporting unit's functional currency. Confusing its treatment with other assets is a frequent mistake. Key to remember: goodwill remains at functional currency level, impacting impairments, not regular translation adjustments. ASC 830 mandates disclosing the effect of foreign currency exchange rate changes on financial results, and detailed explanations of accounting policies for foreign operations. Forgetting to disclose policy details is a common oversight. Remember, clear, complete disclosures enhance transparency, reflecting currency risk management. ASC 830 lacks specific guidance for hyperinflationary economies, unlike international financial reporting standards, which requires restating financial statements to reflect current purchasing power. The trap is assuming both standards handle hyperinflation similarly. Essential takeaway: ASC relies on U.S. generally accepted accounting principles, general principles. International financial reporting standards mandates restatement for consistency. ASC 830 guides U.S. entities in handling foreign currency matters, focusing on transactions and operations. Key definitions include functional and reporting currency. Transactions are often in a currency different from the functional one, requiring translation to the reporting currency. Understanding the spot exchange rate is crucial for immediate conversions. This standard helps in presenting accurate financials in USD or any chosen reporting currency. The translation model under ASC 830 involves translating balance sheet items using current rates and income statement items at transaction rates. Cumulative translation adjustment is part of other comprehensive income. Monetary items use spot rates, while non-monetary items might use historical rates. Foreign currency gains or losses impact net income. Any change in functional currency demands consistent translation application and potential retrospective adjustments. In interviews, be ready to discuss the difference in determining functional currency between ASC and international financial reporting standards. Remember, mixing functional and reporting currencies is a frequent trap. Disclose functional currency choices and changes, noting their impacts on translation gains or losses within comprehensive income. Keep an eye on currency fluctuations and local economic conditions, as they significantly affect foreign operations and financial positions. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.